Now that we're at the stage of the property cycle where capital growth is slower, and it's likely to remain that way for some time, more investors are asking, well, what's the right investment strategy? Recently, Gail Kelly, the CEO of Westpac, warned that Australia is unlikely to ever again see the type of housing boom that sparked a massive rise in personal wealth in the past decade. Around the same time, Reserve Bank Governor Glenn Stevens said the Reserve Bank was not trying to engineer a return to house price booms by lowering interest rates. So what's an investor meant to do? Is it time to consider cash flow positive properties? Hi, I'm Michael Yardney, and today I'd like to have a bit of a chat with you about what the right strategy is for this stage of the property cycle. But before I do, I firstly want to remind you that if you want to understand my strategy that's worked well and has worked for lots of investors, have a look at my book, How to Grow a Multi-Million-Dollar Property Portfolio in Your Spare Time. You can get it at our website on Property Update or at your local bookshop. Okay, let's understand what the right strategies for this stage of the cycle. But firstly, it's important to understand how property investors make their money. And they make it in four ways. First of all, through capital growth. That's the increase in value of your property. Number two, through rental returns. That provides the cash flow to pay your mortgages. Number three, through tax benefits. Things like depreciation benefits, negative gearing, those things. And number four, through forced appreciation. This is where an investor manufactures capital growth through renovations or development. Now, smart investors use a combination of all of those things. They benefit from all of them. Some people are asking at the moment, well, can I still get capital growth? Only last week I saw a report from AMP Capital where Dr. Shane Oliver, the economist, reported that since the 1920s, residential real estate in Australia has returned 11.1% per annum. And that was allowing for all the costs, and that was a combination of capital growth and rental returns. Now that's a pretty impressive long-term track record. While there's little doubt that the average capital growth is going to be lower for the next few years, there are always pockets that outperform the averages. And within those areas there'll be some properties that grow strongly, they increase in value, while others are going to perform poorly. That's just how averages work. So some people are saying, well, what about positive cash flow? A positive cash flow property is one where the rental income covers all the property's expenses, including interest. And that leaves money in your pocket each month. In general, properties with higher capital growth have lower rental returns. This means you usually can't find cash flow positive properties in higher growth areas, in better locations in our capital cities. That means you may have to look for regional areas, for areas outside to get strong cash flow to make up for the lack of capital growth. Of course, if you borrow less money, if you put less money in, you have a lower loan to value ratio, you can end up with positive gearing as well. But the problem is if you do that, you miss out on leverage. So some people are asking, well, what's a better strategy, cash flow positive or capital growth? I guess there's no simple answer. Clearly, if both strategies exist, there's a place for both. I see more beginning investors go for cash flow positive properties. On the other hand, I tend to see more successful investors, more strategic investors, those who've built a substantial asset base, grow their portfolio through leveraging and gearing and getting capital growth from the investments. Now, obviously, property investment should be part of a bigger picture wealth creation strategy, not just the purchase of an individual property in isolation. So if you're considering getting involved in property investment and you're planning to build an asset base, and one that may one day replace your personal exertion income, replace your salary from your job, then I'd always invest for capital growth. A few dollars a week extra positive cash flow isn't going to change your lifestyle. It's not going to make a difference to your lifestyle, and it's definitely not going to give you the ability to service and acquire other more desirable properties in your portfolio. The problem is you just can't save your way to wealth, especially on the measly couple of dollars a week positive cash flow you're going to get in today's property markets. And what's going to happen when interest rates eventually rise? And they will one day. The property that's today cash flow positive may end up being cash flow negative tomorrow. Think about it. Real wealth's not derived from income. It's achieved through a long-term strategy of capital growth, capital appreciation, and the ability to refinance to buy further properties. If you seek a short-term fix with cash flow positive properties, you're going to struggle to grow a future cash machine from your property investments. But there is a trick. You can't really turn a cash flow positive property into a high growth property. You can't because of its geographic location, but you can achieve both high growth returns, cash flow, and capital growth by renovating or redeveloping high growth properties. This way you're going to get better rent return, you're going to get some extra depreciation allowances, and this converts high growth, relatively low yield properties into high growth, strong cash flow positive properties. This means you get the best of both worlds. But how do you cope with negative gearing in the meantime? Of course, investing in negatively geared high growth properties means you've got to cover the cash flow, the shortfall every month. One way of doing this is to structure yourself correctly with your loans. A line of credit can be used to supplement the rental to pay the interest on the investment loans and on your property expenses. This buys you time to see you through the cycle. A line of credit is often set up to cover a shortfall, 2 or 3 years, until the property value grows sufficiently to refinance the loan and get extra equity. To use this investment strategy though, correct asset allocation is critical, because to make it worthwhile, you need the property's value to increase significantly. It's got to increase substantially more than the outstanding loan balances increase when you're borrowing to service your loans. This means you need to be investing in high quality assets so you can get maximum chance of enjoying strong capital growth. Now, this strategy isn't without risks. Let me maybe run through 4 of the common risks. Number 1, poor capital growth. If you don't have the right capital growth, you're going to be in trouble with this negative geared strategy. That's why correct asset allocation is important. Number 2, there's an interest rate risk. That can be addressed by fixing interest rates on some or all of your debt if you're worried interest rates are going to get out of hand. Number 3 is poor rental growth. You need strong rental growth. This again highlights the importance of owning the properties that will be in continuous strong demand by the widest demographic of tenants. And number 4, the lack of financial discipline. See, I see some people using their financial buffers for other uses rather than covering property-related expenses. So in summary, I can understand why beginning investors would be keen to buy a property with positive cash flow. They tend to be cheaper. It's easier to purchase them. It's easier to support this type of property. And while they may give you some short-term income, these properties will never allow you to accumulate the equity necessary to become truly prosperous. And while the rent may seem relatively high initially, it's the ongoing capital growth of your properties that are going to underpin the long-term rental growth, which means if you buy in areas of low capital growth, your rents won't rise over the years as much as rents in high growth areas. This means the value of capital gains over the long term will blow comparable cash flow returns out of the water. Now remember, as a good property investor, you should focus on safely building your asset base so you can eventually develop the passive income that you want from your assets that one day will give you the financial freedom you desire. To be a successful investor in these turbulent times, you need to surround yourself with a team of independent and unbiased property advisors, not salespeople. A team of people who have got a system that's known, proven and trusted. So it's probably appropriate at times like this to remind you that nobody can quite help you like the independent team of property strategists at Metropole. Remember, the multi-award winning team at Metropole have got no properties to sell, so their advice is independent and unbiased. If you want to find out a bit more about what's happening in your local market and what our research suggests is in store, why not join us at a free property briefing in Melbourne, Sydney or Brisbane, or with our associates in Perth. Just click on the link below to find out more and reserve your place. I look forward to seeing you in my next market update in 2 weeks' time.